Hello, all you clever capital investors. Today, we're diving into an important topic for commercial real estate investors. Always my number one question, understanding how depreciation works in a commercial real estate fund. Depreciation can significantly impact your investment returns, tax liabilities, and your overall financial strategy. So let's break it down. First things first, what is depreciation? Depreciation is an accounting method that allows investors to spread the cost of a tangible physical asset over its useful life. In the context of commercial real estate, it means you can deduct a portion of the property's cost every single year, which will reduce your taxable income. This non-cash deduction acknowledges that buildings and improvements to those buildings wear out over time, even if the market value might increase. So we love depreciation because, hey, who doesn't want more deductions off of their income? For commercial properties, the IRS sets the useful life of a building at 39 years. This is the standard. This means you can depreciate or deduct the property over a 39-year period. Here's how it works. Okay, first determine the depreciable basis. The depreciable basis, it's a tongue twister, is the property's purchase price minus the land value, since land cannot be depreciated. For example, if you purchase a property for $1 million and the land is valued at $200,000, your depreciable basis is $800,000 because we minus the land. Here's how you calculate the annual depreciation. You divide the basis by the useful life of 39 years. So using our previous example, we'll take 800,000 divided by 39 years equals approximately 20,500 per year. This amount can be deducted annually, so every single year from your taxable income. Now, imagine if you took advantage of bonus depreciation. What? There's a bonus? Yes, this actually shortens the life cycle from 39 years to anywhere between 5 to 15 years. So the benefits of depreciation offer several key benefits for investors in an actual fund. Depreciation reduces your taxable income, lowering your overall tax liability. This means more for your rental income can stay in your pocket instead of going to the IRS, which we all love. Of course, by lowering your tax bill, this means it can improve your cash flow. This extra cash can mean you reinvest it into the property, you use it for other investments, or you just save it for future expenses. Depreciation also increases your after-tax returns, making your investment more profitable. This is especially beneficial in high tax environments. So, important considerations. While depreciation offers significant advantages, there are a few important considerations to keep in mind. Recapture tax. So when you sell the property, the IRS requires you to pay a recapture tax on the depreciation you've taken. This tax is calculated at a rate of 25% on the depreciated amount. It's crucial to plan for this when considering the sale of the property. Then there's the improvements. So any improvements made to the property, such as renovations or additions, can also be depreciated. However, these improvements may have different depreciation schedules. For example, certain improvements might be depreciated over a shorter period of time, such as 15 years. And then there's cost segregation studies. Cost segregation helps truly maximize the depreciation benefits. Investors can conduct a cost segregation study. This study breaks down the property into various components, allowing for accelerated depreciation on certain items, such as fixtures and equipment, which can be depreciated over 5, 7, or 15 years instead of 39. So it's condensed a little bit. Here's an example. Let's consider a practical example to illustrate how depreciation works in a commercial real estate fund versus a singular property. Suppose you invest in a real estate fund that acquires $5 million office building. The land is valued at $1 million. That leaves a depreciable basis of $4 million. Using the standard 39-year straight-line depreciation method, that annual depreciation deduction would be approximately $102,000, which is $4 million divided by the 39. If the property's net operating income, or NOI, is $500,000, the depreciation deduction reduces that taxable income to $397,000, which is that $500,000 minus the $102,000. This reduction in taxable income leads to significant tax savings, enhancing the overall return of your investment. Conclusion: understanding how depreciation works in commercial real estate, whether it's a fund or an individual asset, is essential for maximizing your investment returns and minimizing your tax liabilities. By leveraging depreciation, you can improve cash flow, increase after-tax returns, and strategically plan for your future. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and leave your questions or comments below. I love to hear from all of you and happy to respond to every single one of you. And remember, always consult a tax professional or a financial advisor to ensure you're making the best decisions for your specific situation. Until next time, happy investing. Thanks for watching. We'll catch you on the next one.